Hello students, this is a lecture extending lecture 3 and it's going to particularly focus on dividends. So what we're looking at in this lecture is again the calculation and accounting for dividends on different classes of shares. I'd covered this briefly in lecture 3 as I said, but I'm going to be extending the discussion in this lecture. So I'm first going to talk about dividends on ordinary shares. Dividends, when we declare a dividend, or rather when a company declares a dividend, the dividends are going to be paid based on the shares that are in issue at the date of the dividend declaration. The shareholders who registered at the date that the dividend is declared will receive the full ordinary dividend for the period, even if they only own shares for part of a period. So if a dividend is declared, for example, on the 31st of December and you bought your share on the 30th of December, you will be entitled to the dividend because you own the share on the 31st of December and you will get the full dividend. With regard to ordinary dividends, the dividends are announced per share. So the company would say, for example, that the dividend is 10 cents per share. The company can decide to declare an interim dividend during the year and a final dividend at the end of the year, or it may only have an interim dividend, or it may only have a final dividend. It's really up to the discretion of a company. The one does not have an effect on the other one. Whether it's an interim or a final dividend, the accounting treatment will be the same. And I'm going to show the accounting treatment to you in the next slide. We record dividends when they are declared because at that point we have a liability. We have to accrue for the dividends because they are profits of the company which are going to be paid out to shareholders. They might not get paid out immediately, but we now have a liability to pay the dividends to the shareholders at the date when the dividends are declared. So let's think about the accounting entries for dividends. So let's say the company declares on the 28th of February 2006, they declared dividends on ordinary shares of 22,500. So we debit dividends on ordinary shares with 22,500. That's an appropriation of profits account. I'll show you the general ledger account now. And we credit shareholders for dividends. This is a liability. This is the amount that we owe to the shareholders for the dividends that were declared. The dividends on ordinary shares are not shown on the statement of profit and loss. We end up showing them on the statement of changes in equity, and I'll show you that again in this lecture. The shareholders for dividends are a current liability that we show in the statement of financial position. At the end of the year, this amount for the dividend of 22,500 is going to get debited to retained earnings. Debit because it's reducing retained earnings. So the closing entry at the end of the year is to credit dividends on ordinary shares because we originally debited those, and we debit retained earnings. Dividends are a reduction of retained earnings. It's an appropriation of the retained earnings paid out to the shareholders as an ordinary dividend. So this is what the general ledger accounts would look like. So the first journal entry was where we debited dividends on ordinary shares with 22,500 and we credited shareholders for dividends, that's your liability, with 22,500. The next entry is your closing entry where you take the 22,500 out of the dividends on ordinary shares account. So that means this account now has no balance remaining, and we take the debit to retained earnings. Retained earnings would have had an opening balance, and we'll look at the rest of the entries in the retained earnings account. but what's important to realize is that dividends on ordinary shares end up being debited to retained earnings. They're reducing retained earnings. Then finally, to finish off this example, to close off your retained earnings account, your profit or loss for the year taken from the profit or loss account would be credited to retained earnings, and then you would take your opening balance plus your profit for the year, subtract your dividends, and that would give you the closing balance on retained earnings. These transactions for retained earnings get shown on the statement of changes in equity. Your shareholders for dividend account at the end of the year has a balance of 22,500 Rand. It's a liability, it's a credit balance. So this is what the statement of changes in equity looks like at the end of February 2006. And you'll see here in your retained earnings column, you have dividends in a bracket. Remember, brackets is a debit. Everything in the statement of changes in equity has credit balances. If it's in a bracket, it's a debit amount, which is reducing the credits. Remember, equity are the amounts that we owe to the shareholders. They are a form of liability to the shareholders. It's their investment in the business, but retained earnings is a reduction of their investment because we're paying out part of the profits to the shareholders. So this retained earnings column here is basically just a replication of what's in the retained earnings general ledger account. If we now think about dividends being paid on the 31st of March, then we credit the bank account because we are making a payment, reducing bank, and we're going to debit our liability, shareholders for dividends. So when you make the payment, you debit the liability, you don't debit dividends. So the payment goes here to the debit of shareholders for dividend account. The shareholders for dividend had a credit balance, and now we've paid that amount. Most of the time, the dividends are not paid immediately, so usually you're going to be debiting dividends and crediting shareholders for dividends and paying them later on. If there is a case where the amount is paid, where the dividends are paid immediately, then instead of using the shareholders for dividend account, everything will go straight to the bank account because the payments will come straight out of the bank account. But most times in the question, we don't make the dividend payment immediately, which is why we need the shareholders for dividends account. So the shareholders for dividends is a liability account to show the amount that we owe to shareholders. So now let's talk about dividends on preference shares. Preference shareholders are always going to get paid their dividends before ordinary shareholders. We use the word preference shareholders because they have a preferential right to receive dividends, and also if a company gets liquidated, the assets are sold and the liabilities are paid, the preference shareholders will get their money back before ordinary shareholders. Ordinary shareholders therefore carry more risk because they are the ones who get their money back last, and they don't get dividends unless the company declares the dividend, and they get the dividend last. But the ordinary shareholders are the ones who will actually have voting rights when general meetings are held and decisions are made regarding the company. So they are the true owners of the company in that regard. In FRK 121, you're going to assume that preference shares are cumulative unless we tell you otherwise. Cumulative means that if a dividend doesn't get paid in 1 year, that has to be paid the next time dividends are declared. But in our questions, we are normally going to always make sure that the cumulative dividends are paid every year as they should be. Cumulative dividends have to be paid out before non-cumulative preference dividends, and those are paid out before ordinary dividends are paid out. So non-cumulative preference dividends means that the preference shareholders are not entitled to their dividend every year unless the directors decide to declare a dividend. Whereas cumulative preference shares are entitled to receive a dividend, and if it doesn't get paid in 1 year, then they have to get paid the dividend the next time. Ordinary shareholders always get their dividends last. In most of the questions, you will see that dividends are normally announced per share, but sometimes for ordinary shares, dividends are announced based on the face value or the rand value of the shares. This is fairly common with preference shareholdings. So, for example, if a company has 100,000 worth of preference shares that it has issued to preference shareholders, it might say that those preference shares are going to get a cumulative dividend of 10% per year, and that 10% is based on the face value of the 100,000. That then gives us a 10,000 Rand dividend. So that's another way of working out the dividend, is by working it out as a percentage of the face value of the shares, and we only do this for preference shares. With preference shares, you will not see interim dividends in any of the questions we give you. We'll only possibly see them on ordinary shares. Dividends on preference shares are apportioned for the number of months in which the shares were in issue. So if a company only issues preference shares partway during the year and then declares the dividend at the end of the year, the dividend will not get paid for the full period. So if it issued preference shares 3 months into the year and it then declares a dividend 9 months later at the end of the year, then that preference dividend will be apportioned for 9 months, because that is the period of time in which the company had the money available from the shares that it had issued to preference shareholders. Now let's talk about dividends on redeemable preference shares, remembering that preference shares can be redeemed in terms of the Companies Act. That means we can buy them back from the preference shareholders. The preference shareholders gave us money, we issued shares to them, then we can buy back the shares and pay back the preference shareholders the money they gave us. However, there are 2 options. If the redemption is at the option of the company, it may be that the company will never pay the shareholders back. So in that case, we consider the preference shares to be equity. And any dividend that's paid on those preference shares will get treated like a normal dividend. And the example that I did for you on ordinary shares would therefore be applicable for preference shares where the redemption is at the option of the company. But if the redemption has a fixed date that we say we are going to pay back the shareholders at a future point in time on a certain date, or it's at the option of the shareholder can demand at any point maybe that the company pays the money back, then those preference shares must get disclosed as a liability, not as equity. And then the dividend on those preference shares is treated as an interest expense. And I'm going to show you an example now of how that works. So when redeemable preference shares are treated as a liability, at the date when you declare the dividend on the preference shares, instead of debiting dividend on preference shares, you're going to debit interest expense, which is an expense that's going to go onto the statement of profit and loss as part of finance costs. And you'll credit accrued expenses, which will go on your statement of financial position under current liabilities with trade and other creditors. At the end of the year, the 22,500 Rand for interest expense is going to get taken out of the interest expense account. We'll credit the interest expense account and debit the profit and loss account, because all expenses and incomes get cleared to the profit and loss account at the end of the year. So in our general ledger, this is what it will look like. The first entry was where we created the dividend. This is the amount that's owing for the year, but instead of debiting dividend, we're debiting interest expense, because this is a liability. These preference shares have to be paid back, and we credit accrued expenses, not shareholders for dividends. At the end of the year, the interest expense of 22,500 Rand is going to be debited to profit and loss. That's where we clear the interest expense. And then at the end of the year, we'll have an amount owing of 22,500, which is like your shareholders for dividend account, but it's not quite the same, because the interest expense is an accrued expense. so we include it as part of accrued expenses. Then in the next year, on the 1st of March, remember at the beginning of the next year, you must always reverse your accrued expenses. So you will debit accrued expenses and credit interest expense. And then when the payment is made, we take the amount out of the interest expense account and we credit bank. So it ends up here that the interest expense account will have no balance on it, because in the next year we don't actually have an interest expense, we just have the payment that is made of the interest expense, which is the dividend to the preference shareholders. So this is what the general ledger accounts look like. The interest expense account at the beginning of the year is going to have a credit amount of 22,500, because we took the 22,500 balance that was on accrued expenses and we're reversing it now at the beginning of the year to the interest expense account. The next entry then is that when we make the payment, sorry, there's a mistake here, it should only be 10. When we make the payment, the 22,500 Rand is going to be credited to bank and debited to interest expense. So we now have no amount left on the interest expense account. The debits and credits contra each other out, and the accrued expenses, the debit and credit, also contra each other out. So those are two examples that I've now shown you for how to account for dividends on ordinary shares or on preference shares that are not redeemable at the option of the preference shareholders or don't have a fixed date of redemption. That was example 1. Example 2 deals with when dividends are paid on redeemable preference shares that have to be treated as liabilities, and then we have to treat the dividend as an interest expense. I hope that helps you with understanding dividend accounting.